Hi, I'm Barbara O'Neill. I'm the owner and CEO of a financial education company called Money Talk. And I'm here today to talk a little bit about walking in the financial shoes of older adults. Now, you might be wondering, why are we doing a presentation on this topic? Well, here's my value proposition. Most of the members of the FinCon community are from generation X, Y, or Z. So you're basically young to middle-aged adults. And yet, throughout the course of your work, you may be interviewing or writing about topics that really kind of affect older adults, like required minimum distributions, for example. And these would be things that you haven't personally experienced yourself. So I thought this would make a really good session for FinCon to help you better understand the issues and mindsets of older adults. So much of the content is based on my new book called Flipping a Switch, Your Guide to Happiness and Financial Security in Later Life. And in this book, I talk about 15 financial transitions, 5 social transitions, and 15 lifestyle transitions that people face in later life. And my inspiration for the book came from personal experience. I was leaving a long-time career at Rutgers University and moving from New Jersey to Florida. So I was experiencing a lot of the transitions that I write about in the book very personally myself. Second, I attended an American Savings Education Council, or ASEC, meeting in July of 2018, and heard a presentation about spending in retirement. And the speaker talked about the fact that many people in retirement are going to be challenged financially, but there's a subset of people who have a unique problem, if you will. And the problem is that they've saved their entire life, maybe 3, 4, 5 decades, and they're not comfortable spending down their money. And the speaker ended the presentation by saying we need financial education to teach people how to flip a switch from saving to spending. So that's how I got the title of the book, Flipping a Switch. My third inspiration was when I was going down to DC to attend that meeting that I just talked about. I was reading an article in the AAII journal about grasshoppers and ants in retirement. And it talked about the grasshoppers who didn't save a whole lot of money. They kind of partied hardy throughout their lives. And then the ants were the people who spent less than they were financially able to. So they continued to live below their means, not only before retirement, but also afterwards as well. And one of the things they talked about in that book, or in that presentation rather, is that people have what they call a habit formation hypothesis, that you get used to living at a certain level and then it's hard to break those habits. So I realized after that presentation that there were many transitions or light switches, if you will, using my metaphor for transitions, that people needed to flip in later life. It wasn't just going from a saver to a spender, but it was also a lot of transitions in the way that people simplify their finances, downsize their possessions, think about philanthropy, just a whole lot of issues. And again, there's 35 different transitions that are noted in my book. And some of these transitions are like dimmer switches. So they change over time. So instead of just being kind of an on and off switch, it's kind of a gradual shifting over time. So for example, working, some people will phase down their work hours, 40 hours, 30, 25, and so forth. Some people will do the same with spending. They'll have gradual transitions. And some people have talked about 3 phases of spending in later life. The go-go years, when you're first leaving the workforce and have more free time. And then maybe the slow-go years when you are a little bit older, maybe mid-70s or so. And then some talk about the no-go years if people have major health issues in later life. So there's different levels of spending during those 3 phases. People sometimes transition the way they do an investment asset allocation, and I mentioned downsizing before. And then even just the way we disengage from some activities that we did during our working years and start to engage with new activities in our post-work life. And simplification is a big thing too. So what I thought I'd do in this session is just walk you through 20 key planning issues for older adults that are derived from the content of my book. And this might give you a little bit of an idea about what people are thinking about. Possibly you have some older adults as clients. Possibly you're going to be writing about topics that older adults are interested in or interviewing some older adults. And it might give you some unique insights into their questions, their mindsets, and their behaviors. So the first one is just the whole concept of spending down, like I talked about before. For some people, they're going to have to step outside their comfort zone. If they've been very frugal for a long period of time and they've saved a lot of money, they may need to kind of transition psychologically from being ultra frugal to spending a little bit more than they might have done previously throughout their entire adult life. Some people will find it helpful to automate their savings withdrawals because psychologically, every time you take money out of an account, it feels like a loss, even if it's not like a stock market loss. And then answering some hard questions. And these are some of the questions that I posed in the first chapter of my book. You know, why did you amass all this savings if you aren't going to spend it? And if you don't spend the money, who will? And then what are you waiting for? It's very unlikely that people are going to have better health throughout later life. For most people, they'll be healthier in their 60s than they might be later on in their late 70s or 80s. Number two is determining enough. And this is a real concern of older adults. Nobody wants to run out of money before they run out of lifetime. So it kind of begs the question, do I have enough money? And there are some really good tools out there. I encourage people to use several of them. One that I particularly like is the FINRA Retirement Calculator. I find that useful. Also, people might want to consider hiring a financial advisor to help do some calculations for them. There's also another type of calculator out there called a Monte Carlo calculator. And what that does is it calculates your probability of having your money last your lifetime. And they typically use a 30-year frame, thinking that people might leave the exit the workforce around mid-60s and live to mid-90s. So all of these tools can be really helpful for people. Now, another issue is creating a paycheck. One way that people can do this when they don't physically have a paycheck anymore is to set up automatic withdrawals from various accounts that they might have. For example, mutual funds will have automatic withdrawal plans. Some people will set up what they call a ladder, where you sequence in maybe 6 months of purchases of bonds or CDs. And let's use bonds, for example. They throw off interest every 6 months. So if you put money in and buy bonds during months 1, 2, 3, 4, 5, 6, you will have income coming off of those bonds in months 7, 8, 9, 10, 11, 12. So you create that ladder. Some people will purchase an annuity, which is a contract with a life insurance company. You give them a sum of money and they guarantee monthly income for the life of one person or joint life of a couple or whatever other way you set up your annuity. And then the other thing I would just caution about is the 4% rule that I'm probably sure all of you have heard about, where you take whatever amount of money that you've amassed in savings and you withdraw 4% of that balance, and then you inflation adjust it annually thereafter. Um, the 4% rule is not set in stone. In fact, there's been some recent research suggesting that with low fixed income interest rates, it should be lower than 4%. And also, it was based on people having about half of their assets in stocks. So if people are very conservative, it wouldn't work for them either. So it just may need to be tweaked over time. Number 4 is taking those RMDs that I talked about, required minimum distributions. So I think the important thing to think about is helping people learn the law, breaking down the process of determining what their RMD is. I should mention there's going to be a new table in 2022 for RMDs, so just be aware of that when you're helping people figure out what they need to withdraw from their tax-deferred plans. And then also another big issue for people is what do they do with the money when they take it out? And there's basically only 3 things you can do with that money. You can spend it, you can gift it, or you can resave it in, let's say, a taxable account. So people need to have a plan when they take that money out, what they're going to do with it. Also, people might want to consider what they call QCDs, or qualified charitable distributions. And if they take the QCDs, which are only allowed for traditional IRAs, the money would go directly to a charity, and it would count for their RMD for the year. So instead of having to add that RMD withdrawal to their taxable income, it goes directly to a charity. And this is a time too where people may want to consider professional advice, just particularly the first year that they take RMDs, just to make sure that they're doing everything correctly. Another issue is investing in later life. So it's always a good idea at any age to kind of do an assessment of your risk tolerance. And I like this tool from the University of Missouri that they use for research studies. And it's 13 questions. It will help you kind of assess where you are. Another thing people should think about in later life, and really throughout your entire life, is rebalancing your asset classes. But the one thing for older adults is they tend to have more money amassed than younger adults. So it's going to take more money to rebalance their asset classes, just because the balances will generally be higher. So something to consider. And then it's always assumed that people get more conservative as they get older. But I have a question mark there, because there's actually been some research that suggests you may have more income and stretch it out longer if you actually have more stock in later life. So it's something that each individual will have to make a decision for themselves. And then there's the whole issue of adjusting to changes in income. You know, when people leave the workforce, their income is going to go one or two ways. It's going to increase or it's going to decrease. And if it decreases, there are a number of catch-up strategies that can work for people. Working longer, working during their retirement, maybe, you know, self-employment or part-time job, spending less, doing kind of what I did, moving from New Jersey to Florida. It's called geographic arbitrage. You go from a high-cost area to a lower-cost area, possibly tapping home equity as well with a reverse mortgage or a sale leaseback. And then there's the whole issue of managing income taxes. So people may have multiple streams of income, and they'll want to either request income tax withholding services, or they're going to have to do quarterly estimated payments to the IRS. Their marginal income tax rate may change, so just helping people understand that. Timing their elective cash withdrawals, because again, there's going to be some planning involved. You don't want to make a bad tax situation worse. So people may want to kind of decide maybe they'll have a year with less income. That might be the year that they take the capital gain, so their overall income doesn't change that much. And again, hiring a tax professional for assistance. Number 8 on my list is becoming a Social Security beneficiary. So this is a big decision for older adults. It's going to happen sometime during their 60s, because the earliest you can take Social Security is 62. For everyone born after 1960, it's going to be 67 for your full retirement age. And it doesn't make sense to go beyond age 70 because the delayed retirement credits end. So people may need help with withholding for their Social Security, their estimated tax payments to the IRS to cover the liability if they're going to be taxed on their Social Security, and many people are these days. Beware of the earnings limit if anybody's going to claim before 67, or people right now, it'd be 66 in some months. You need to know that the earnings limit this year is $18,960. So if you earn more than that and you're claiming Social Security and you're under full retirement age, you would have some of that withheld back. And then the importance of taking care of your spouse. Typical recommendation is to have the higher earner work longer so that they can lay in a good benefit, not just for themselves, but for their spouse if they should predecease them. The next one is focusing on healthcare. So when you leave the workforce, people have 2,500 extra hours. So if you think about 50 hours a week of work, if you had 2 weeks vacation and 50 hours with work and commuting combined, that's 2,500 extra hours. So that's a lot of time for people to take care of themselves. Also consider earmarking part of their savings for healthcare. The study that I had cited in my book was from Fidelity, and they estimated $295,000 out of pocket for a 65-year-old couple in healthcare expenses for the remainder of their lifetime. And also people should expect sticker shock if they're transitioning from an ACA plan with premium subsidies, and then all of a sudden they're having to pay Medicare Part B premiums and D premiums. They may actually be spending more for healthcare than they did when they were working. And then speaking of healthcare some more, there's the whole issue of transitioning to Medicare. So people will need to get educated on that. And a really good resource to suggest to people is the book Medicare and You, which beneficiaries will receive in the mail each year, usually a month or two before the next year. They'll have all the information. And it's also, of course, a PDF on Medicare.gov. People may need to get some help and direct them to either the state health insurance assistance program called SHIP for short, and there's also the SMP that deals with Medicare fraud. People will need to keep good records because they may have their health insurance being combined with, Medicare and individual payments. And it gets complicated when you have multiple streams of payments toward your healthcare expenses. So people may want to keep a good spreadsheet of how much is being paid from each different source. And then if they have a relatively high income, and that would be over $88,000 for a single and $176,000 this year for married filing jointly, they would have to pay extra amounts for Part B and Part D. That's called IRMA payments. And sometimes if you're close to those limits, you might be able to kind of adjust your income so that you don't have to pay the extra amounts. And then there's the whole issue of setting new goals. When we're talking to people who are in the workforce, we tend to think about retirement as being the big goal. So it's to retirement. But when you're talking to older adults who have already been there, done that, it's helping them with their through retirement financial goals. So the things that they want to do short-term, medium, and long-term after they exit the workforce. It could be new cars, it could be trips, travel, philanthropy, whatever. So helping people with that. And also encouraging them to maybe do some upgrades in their spending if they can afford it. And develop some kind of spending action plans, again, that RMD money and other sources of income, and possibly automate their spending and gifting, because again, it's psychologically, it feels like a loss if you're having to take the money out of your wallet all the time. Okay, next one is organizing and simplifying your finances. So encourage people to have a financial inventory that could be readily accessed, perhaps by a power of attorney or a family member if needed. Possibly do some consolidation of their assets, like if they have multiple IRAs, they might want to simplify and get down to one or two instead of five or six. And then financial inventories are really important. We have a number of worksheets on my website at Rutgers Cooperative Extension. There's one for beneficiary designations. There's another one for digital assets. Again, getting all this information written down and then sharing it with the executor of your estate and your loved ones. Philanthropy, it becomes more important to older adults because people start to realize that they can't take it with them. So helping people check out potential charities, using some of the resources that are out there like Guide Store and Charity Navigator, they can be really useful to people when they're deciding where to make their charitable contributions. People can even specify a purpose. They can reach out to a charity, and it could be naming a building or naming a scholarship. You know, sometimes it's okay for donors to talk with the charity and suggest a possible use for their money. Also planning your donations, having a gifting budget can be important, just kind of prioritizing charities in their importance to you as to making donations. And then there's also tax advantage strategies that older adults particularly could find useful, bunching their itemized deductions, those charitable qualified charitable distributions or QCDs that I mentioned before, setting up a donor advised fund, and charitable trusts can all be useful. Another thing for older adults to be aware of is fraud bait. And people will probably be in denial and say, oh, no, I'm too smart for that. But the reality is that many older adults do get caught up in frauds. Caution them about free meal seminars. It's been linked to an increased risk. If you go to a free meal seminar, increased risk of either having a fraudulent or an inappropriate investment. Recognizing some of the red flag language, you know, the guaranteed investments, that sort of thing. And then some of the scams that really affect older adults are text scams, romance scams, and pre-texting scams, where somebody pretends that they're from Social Security or the IRS or the government or something like that. And then another thing is achieving financial peace of mind. And I guess the best way to describe that is just people feeling that they have enough, that they're comfortable, and they don't have to get stressed out about their finances. So status checks are important, using some of the tools that I mentioned, the FINRA calculator, the Monte Carlo analysis, maybe talking with a financial advisor that can also use some of their tools to determine whether you've saved a good amount of money, making some spending projections, you know, just taking your current budget and projecting what you think it might be in later life. And of course, it'll be more accurate as you get closer to the time you're going to exit the workforce. But I know some people listening are probably in the FIRE movement. You might be thinking about leaving the workforce at 35 and 40 and 50. So a lot of these suggestions that I'm giving for older adults can really work for you as well. And you'll need to make some projections and do kind of a pro forma budget of what your income and expenses will be after you leave the workforce. Long-term care is a big issue for a lot of people. It's the big unknown. Nobody knows if they're going to need long-term care services. What I can tell you is that healthy people have a greater probability, because they do take care of themselves and they live longer, and sometimes at the end of their life, they will need long-term care services. So having a plan for that, whether it's insurance or self-insurance. Some people have guaranteed streams of income, and they're going to use that basically as their long-term care plan, but just having some kind of plan for that. And then also, when you achieve financial independence and have financial peace of mind, just savor that, because a lot of hard work went into that, and this is the time to enjoy that. Okay, a few more tips that come from the social and lifestyle parts of my book. One is answering the what do you do? You know, if you're no longer working and somebody asks you that question, how are you going to answer that? And the one thing you don't want to do is have people impose what they call a social clock on you. In other words, their perceptions of what people should do at certain ages. So you define your own what to do. And it can be humorous. It could be, I do anything I want. I do as little as possible. Or you could answer it with the new job that you're doing, your side hustles, your volunteer work, whatever you do with your time. That's your answer to that question. Identity bridging, research has found that if people carry over some of their pre-work life to their post-work life, they're happier because they're not going cold turkey completely. They're doing things that they enjoyed before, and they're doing it after they leave the workforce. So it could be, you know, some volunteer work or some caregiving that they do, whatever it is that brings them happiness. Keeping up the commitments that you really value. And then, like I said before, having that elevator speech ready so when somebody asks you what to do, you can reel that right off. Finding fulfillment. Notice that find is in caps, and that's because it's an acronym that I developed. Instead of fire, I prefer to use FIND, financial independence, new directions. And there you're just going to need to figure out what is going to fulfill you after full-time work and leave work with a plan. So that's something to really counsel people about, is make sure that they know that they need to have some things lined up so they're not unhappy campers. If they are going to leave the workforce, all the research suggests you don't leave for very long, because if you're gone more than 2 years, you're going to be considered rusty and irrelevant, and it's going to be hard to get back to doing the work that you love. So you pick out the things that you like, and that's what you're going to do, and in your work life or in whatever other pursuits that you have to make you happy. And unfortunately, people need to expect ageism. So I write in the book about some things that people can do to combat ageism. It basically boils down to you know, maybe some trendy clothes, certainly keeping up your skills, keeping up your contacts, keeping up your professional development certifications, that sort of thing, possibly even dyeing your hair, whatever it takes to not come across as being an older person can help you if you intend to stay in the labor force. Next on the list is downsizing and divesting. So I heard a speaker once, Jamie Novak from New Jersey, who is a downsizing organizing expert, and she talks about starting with 10-minute increments. So if you've got all the stuff that you got to do to downsize and organize, just break it up. So just start with 10 minutes here, 10 minutes there, and break a large task down into many small different tasks. If you're going to reach out to people who possibly might be interested in your stuff, you'll want to get in touch with them. If you're going to be downsizing like a 3-bedroom house to a 1-bedroom townhouse, you're going to have to empty out extra rooms. Divest your duplicates. You know, if you have 3 tablecloths, maybe you can get by with 1. And then professionalize your yard sales. And there's some tips in the book about doing that, you know, price tags on everything, that sort of thing. Older adults will have a changing time orientation. So I coined a term in the book called ROLL, return on life expectancy. And just consider that when you're talking with older adults, that they're mentally calculating, will the dog live longer than I do if they're going to get a pet? Or how long will this refrigerator last? You know, it's just because you come to a point in your life where you've lived more time than you have time left to live. And you need to consider that older adults have that lens. And they might want to spend lavishly on some of those last things, like their last car, if they think it might be. And then the last thing I want to talk about is just invincible to vulnerable. So when I was finishing my book, COVID was on the scene and older adults were being told that they were called the elderly, but we were also being told that our immune systems were not what they should be. So just helping people stave off disease, delay any chronic diseases like diabetes, following healthy recommendations, getting vaccinated and screening tests, and just encouraging people to remember that their greatest wealth is health. So if you tie health and wealth together, it gives you the license to be writing and speaking about some health issues as they relate to personal finances. So they told me to keep this to 30 minutes, and I'm looking at my clock and I'm almost there. So I just want to thank you for listening to this presentation. I hope you found it useful as some insights into the mindset and the finances of older adults. And I encourage you to purchase my book if you would find it of interest into your work. Thank you very much. Bye.